Baseball's new way of thinking on closers is causing managers to go to their bullpen and their star relievers earlier. But what does that have to do with the Fed and its coming call for a rate cut? Mike Santoli has a story. Mike?
Carl, yeah, right now, if you look at the economic data, it doesn't seem like we're particularly late in the game in terms of the expansion. Unemployment's low, markets at their highs, credit markets are fine, the VIX is pretty low. So why is the market now pressing the Fed to come in with really what you might consider its strongest weapon out of the bullpen, which is going from a tightening move to an ease? Well, it's part of the same logic that has baseball quants saying that why wait to use your weapon at the very end of a game when there might not be a threat. If there is a crucial moment in the game before the ninth inning, you should bring in that closer. And that seems to be what the markets are saying. A rate cut right now would be the equivalent of bringing your best weapon in to diffuse a threat before you actually need to use that person later on down the line. Now, the quants, both in baseball and in finance, are using this argument. You hear people talking about an insurance cut, right? Cut rates now so you don't have to have a full easing cycle to ward off a recession later. That's basically what we're talking about now. Now, what are the risks here? I think, to me, the risks are that the Fed actually does start to ease. It turns out not to be necessary. You've kind of used that weapon in a way that really is not most effective, because now down the road you don't have that rate cut in your pocket, and in fact the market might go on to new heights and the economy would have done fine anyway. If you look at the setup of the Treasury yield curve, which really is the thing that's kind of calling on the Fed to make this kind of a move, you see this very, very inverted structure, right? We have 3 months, very high, 228, all the way down to about 185 in the 3-year maturity. But then what happens? It starts going up to 213 over 10 years and then even higher later on. The market is hinting that, in fact, it might work, that if we got a rate cut now, that's all you might need to do, 1 or 2 cuts this year, pretty soon this summer, and then all of a sudden the economy does better, inflation picks up again. So that's the argument. I don't think the Powell guys actually is all that comfortable with this new kind of quantitative thinking, and I think that's why they're hoping just suggesting something might happen in the way of a rate cut might be good enough. And with the way the markets are acting now, it's hard to really argue that we urgently need one, isn't it?